Welcome to BlackPoint Capital Partners monthly market recap for the month of September. I'm Mauricio, managing partner here at BlackPoint Capital Partners, and I'm joined by our Chief Investment Officer, Arun Kaul. Each month, we will take a few minutes to walk through some major economic and market themes shaping investor decisions moving forward. But before we begin, a quick disclosure: this commentary is a general communication provided for informational purposes only, and its educational nature is not designed to be investment advice or taken as a recommendation for a specific product, strategy, or plan. Moving on, what we will be discussing today: some of the U.S. market commentary for September 2025, economic growth for Q2 being revised higher, economic growth moving forward into Q3 closer to about 4%, some notable slowdowns in the payroll and growth sectors, some initial claims for unemployment are not rising, and the Fed began cutting interest rates in the month of September. And then lastly, finishing off with earnings growth for S&P 500 and where we see things moving forward. But before we get started, Arun, just a question to you. With some developing news that happened at the midnight last night with the government shutting down, could you tell us a little bit more about that, just how that might affect us going into the month of October and going into the last quarter here for the rest of the year?
Yeah, certainly. Historically, the government shutdowns have not had significant long-term impacts on the economy. Right now, the expectation, if you look at some of the betting markets, is that the shutdown will last from around 5 to 15 days. For now, that's the expectation. So generally, the impact should be minimum, but with the current administration, looking back at last parallels or historical parallels may not be as accurate. So for now, minimal impact is expected in markets in the near term.
Okay, perfect. Thank you. And then moving on to that, can you tell us a little bit more about some of this GDP, the revisions that happened in Q2 and what we can expect for the rest of the year?
Right. So the Q2 number was revised higher for the second time. The initial report was 3%, and then the revision took it to 3.3%, and the most recent revision, the final revision, took it to 3.8%. So substantially stronger growth than had been anticipated. And certainly this is a direct response to Q1, where growth was negative, largely because of a significant build in imports in anticipation of the administration's policy to introduce tariffs. So this was largely a reversal of Q1. If you put those two quarters together, you get about 1.5% growth as an average. So still a little bit low, but a strong quarter nonetheless for Q2. And as we roll forward towards Q3, the current nowcast from the Federal Reserve is that the economy is growing near 4%. So that would be back-to-back quarters above 3%, which would be in line with the administration's target for 3% growth, which is the Treasury Secretary's mandate or target for the growth level across their 3-3-3 objective.
Okay, and it sounds like these numbers are coming in pretty high. Do we think the strength is sustainable going into the rest of the year, or do we think there's maybe a slowdown heading into 2026?
So what we're seeing is that there's a tremendous amount of pro-growth policy coming from the administration, very active, very hands-on in terms of direct investments, build in America, and tariffs really meant to support more building and manufacturing of critical industry. So I think the direction that we're on leads us to stay in this range around 3%. And that seems to be supported by much of the policy from the administration, including their lowering of taxes or lowering taxes back in the big, beautiful bill, which is certainly a strong foundation for more investment in the country.
Great. And I know the GDP is one thing that we take a look at, but tell us a little bit more about some of the payrolls and what we've seen as some of the slowdown across the board.
Yeah, so payrolls are definitely more difficult to navigate through. The backdrop has 2 or 3 macro drivers. Certainly immigration. The border is largely closed at the southern border, which does impact the flow of individuals and labor into the country. And of course, the government is now actively seeking to remove immigrants that they believe are here illegally. So that's definitely having an impact on the workforce. We're also seeing a pretty accelerated adoption of AI, which is driving many firms to drive efficiencies higher using automation and other agentic AI type of processes. So while we've seen hiring slow down, we have not seen layoffs accelerate. So as a percentage of the overall workforce, layoffs have been very low, near all-time historic lows. We would need to see this number move up towards previous levels, about 0.4, 0.5% of the workforce, to be in recessionary territory. So we are not there right now. So hiring has definitely slowed down, but job cuts are not seen yet.
Okay, and would you say this is a sign of a soft landing, or are some of the labor data lags masking some of this future weakness?
Yeah, we certainly have had a tremendous number of revisions with the data series as well. That's an important point. So there's still a little bit of confusion as to what some of the exact numbers may be, in part because the surveys are not being completed in a very high degree by some of the businesses, some of the households. And now with the government shutdown, we're going to lose or not have some of the data be reported over the next week or two if the government shutdown persists. So we're going to have even less data. So it's really a mix of those three areas, where it's the immigration, it's the AI, and it's the lack of transparency or limited transparency in some of the government inputs in terms of what the actual data is. But at a 3% growth rate, that's still quite favorable for the overall economy, but you're definitely seeing it have very different impacts industry by industry.
Great. Then moving on, can you tell me a little bit more about some of the real rates that we're seeing across the board?
Right. So from the labor market, the Fed did cut rates last month, and they pointed specifically to weakness in the labor market. That was their concern. They're still concerned about inflation. That's their dual mandate, is the unemployment rate and inflation. So they saw weakness in one, which is the unemployment rate, and they reduced rates. Now, if we look where we are today, inflation is around 2.4, 2.5. I guess the core is about 3. And then the real rate is about 140 to 150 basis points above that. So looking at the last 25 years, those are high real rates versus the last 25 years. Now, rates were negative. Real rates were negative since 2008, after the great financial crisis. So that might not be the best period to look at, but certainly if you go back into the late 1990s, real rates were high, around 2%. So the question really is, what is normal? We think a rate around 75 to 100 basis points is normal. So if inflation long-term is around 2 to 2.5, that gets us to about 3 to 3.5 on the federal funds rate, which would be another 1 to 3 cuts in the next year.
Okay, and how might this impact credit-sensitive sectors, and where do we see this new normal for real rates settling moving forward?
Yeah, so the new normal, I think, is really difficult to define. If we look back at the history, we definitely had each decade, set of decades, having a very distinct level of what is normal. So I think we settle back into a period of time that looks like between the late 1990s and the early 2000 period, which would be around 50 to 75 points. Certainly, those industries that are highly levered, this is beneficial for them on the short end. In particular, small and middle market lending companies, which do a lot of floating rate lending, will see reductions in the cost of capital, and that's definitely beneficial for that segment of the market. And they have been experiencing slower growth, given that rates have been higher. So the higher rates have not impacted the large cap companies, which is the S&P, but it certainly has impacted some of the Main Street companies, which are smaller and middle-sized businesses.
Great. And speaking of the S&P, can you talk to me a little bit more about some of the earnings, the forecast that we're seeing going into Q3?
So earnings continue to be quite favorable. We're looking at about an 8% growth rate year over year for earnings for Q3, which we're just coming into starting next week. And if we look at the expectation for Q4, we're at 7%. And then we're looking at some quite strong numbers for 2026, up in the low double digits, around 11 and 12%. So we'll see if those numbers hold. but that 8 to 10% range is overall quite positive for the S&P.
Great. And so are these earnings broad-based, or are they in a few large sectors such as tech or AI that is mostly carrying the momentum in the S&P?
Yeah, so that's a good question. So definitely tech is leading. We're also seeing industrials with some good growth, and consumer discretionary is roughly in line with the market. So it's generally broader based. It's not extremely narrow. We are seeing consumer staples and healthcare with lower growth rates. And we're seeing energy numbers that might be a little more positive now that energy is finally bottomed around $60 in terms of the price per barrel. So the earnings are reasonably broad-based, but certainly they have a tech and an AI bias to them.
Perfect. And so last question here then, with GDP strength, resilient labor markets, high real rates, and some solid earnings, where should investors be cautious, and where might there still be some opportunity going into the last quarter of the year?
So we do think the market is still expensive and definitely skewed towards a handful of very large tech names, the NVIDIA, Microsoft, Apple, Google, and Meta, the Mag 7. Although some of those names are reasonably priced given the higher expectations for growth. So we still think it's very much a stock picking environment in terms of investors. There might be some focus on thinking about raising international exposure, given some of the valuation differentials. And on the credit side, the spreads are quite tight. So corporate bonds are near historic lows, as are high yield, both high yield and investment grade. And certainly private credit has much higher spreads for some of those middle market companies, but we see some of those rates coming down as well. So we would say it's selective in both public debt markets and private credit and public equity markets in terms of investors and allocations going forward.
Perfect. Well, thank you very much for that, Arun. As always, we will continue to monitor these developments closely and keep you updated as things evolve. Thanks for tuning into our September recap, and we look forward to connecting with you again next month. As always, at the end of the calls, if you can, please reach out. If you have any questions, reach out to any of your advisors that you're working with here at BlackPoint, or if you have any just general questions, please don't hesitate. Reach out to the info@blackpointcp.com inbox, and we'll get back to you shortly. Thank you very much. Have a great day.
Thank you.